For the last 2 quarters, I've been making videos pondering if Nifty 50 will cross 26,000. And in both quarters, it came really close, but pulled back due to earnings shortfall. Now, we are right at the cusp of Q2 earnings kicking off, and we find Nifty 50 on the brink of crossing 26,000 once more. So let's tackle the same question now. Will Nifty hit 26,000 after Q2? Our analysis shows 2 to 3% market gain is possible based on sector-wise returns. But first, a reality check. Nifty at around 25,200 now, so we are talking about 3 to 4% lift from here. Forecasts are optimistic. Some analysts see us heading to 25,450 soon and then 26,000 by Diwali if earnings surprise positively. JP Morgan eyeing even higher at 26,500 in 9 months. The key: if Q2 beats expectation, think of strong domestic plays offsetting global drags, then we can see this momentum carry through. We have crunched the data for Q2 across all 7 key sectors, analyzing domestic demand versus export performance, along with drivers like tariff, rupee effect, and policies. Breaking it down simply by sector with good and bad news, tariff impact, AI's role wherever relevant, and projected earnings, and see how it could influence Nifty's journey to 26,000 and beyond. Let's start with IT. The Indian IT sector has so far recorded a muted year-on-year growth of 5 to 7% in Q2, edging past the modest 0 to 2% expectations, but this growth is hampered by weak sequential performance and signals ongoing caution. On the bright side, major players like HCLTech and TCS demonstrated strength. HCL billed over 100 million from AI-driven projects, while TCS maintained stable margins and focus on AI integrations, collectively highlighting the sector's pivot on high-value tech. However, challenges loom. AI advancements risk displacing up to 2 million jobs by 2025, potentially trimming overall growth by around 2.5% during this transition. AI's impact on IT services demand remains a critical concern, even as its adoption soars. Looking forward, FY26 earnings are projected to stay flat, with margins holding steady at 20 to 22%. For Nifty 50's push toward 26,000, IT's current underperformance acts as a temporary drag on sentiment, but breakthrough from leaders like HCL and TCS in AI could catalyze a rebound, accelerating the index's jump if global spending revives among the ongoing rally. Moving on to banking. The sector faces subdued Q2 earnings, with PAT expected to decline 11% year-on-year due to margin compression and slowing loan growth at 9 to 10%. Good news: deposits grew at 8 to 9% and potential CRR cut released 3 lakh crores, boosting credit by 2%. And bad news: corporate loan stress from tariff-affected borrowers. We expect weak Q2 credit growth at 12 to 13%. And because banking weight on Nifty is about 35%, any weakness in banking will make it a significant drag for Nifty to achieve 26,000 in the near term. Oil and gas sector. Steady domestic consumption has helped contractions limited to 3 to 5%, aligning with flat to mild decline forecasts. Good news is that Russian pivot and yuan payments mitigated supply issues, while geopolitical tensions amplified the import costs. Tariffs hit petroleum exports are down 3%, but rupee helped. AI emerged in exploration but limited Q2 impact. Projected earnings, a modest 7.2% growth is expected. This sector's stability anchors Nifty's energy component, but volatility from global prices could cap rallies short of 26,000. Autos sector. The automobile sector posted 1 to 3% year-on-year growth in Q2, which was better than the subdued expectations. On the positive side, September saw record passenger vehicle sales, highlighting a strong rebound in consumer interest. However, wholesale volumes dipped, signaling some inventory pressure. Tariffs had an indirect impact on auto parts, adding to supply chain concerns. Projected earnings for FY stand at 6 to 8%, driven by this September recovery. Overall, the sector's domestic-led rebound supports Nifty's consumer push towards 26,000, providing a stable foundation amid market volatility. Retail and FMCG sector. The combined retail and FMCG sector achieved 5 to 7% year-on-year growth in Q2, mildly outperforming mid-single-digit expectations, and it was entirely driven by domestic factors with 13.9% value expansion. Good news came from waves of rural recovery, revitalizing demand in key areas like staples and personal care, exemplified by DMart's strong performance with revenue up 15.4% year-on-year. On the downside, monsoon-related destocking, high input inflation, margin pressure weighed on operations. Tariff had negligible effects given the sector's low export reliance. Projected earnings remained steady, with easing costs providing some relief. This defensive sector bolsters Nifty's stability, aiding the index's journey to 26,000 amid ongoing volatility. The pharma sector. The pharmaceutical sector recorded 7 to 9% year-on-year growth in Q2, aligning with expectations, bolstered by 8 to 10% rise in domestic chronic therapies. Positive developments include offsets from strong European markets, helping to balance regional challenges. However, bad news stemmed from 100% US tariffs on branded drugs, which are eroding market shares and profitability. Projected earnings for FY26 are steady at 7 to 9%, reflecting the balance. Steel sector. Domestic infra demand drove 10 to 14% year-on-year growth, outperforming the expectations with consumption up. The bad news, coking coal imports are projected to surge by 2030, raising the costs. Tariffs have had minimal impact due to low US exposure, but exports are up 20%, benefited from rupee aid. AI isn't a big factor here, so there is no problem from AI, but projected earnings are stable. The capacity to 300 million tons by 2030. For Nifty, steel strength adds bullish weight to the index's industrial leg, supporting a push forward to 26,000 if infra spending holds. And now the worst affected, textiles sector. The textiles sector achieved a flat 0 to 3% year-on-year growth in Q2, proving resilient against the expected 5 to 10% decline through diversification to markets like UK and EU. On the positive side, this shift helped mitigate some losses. However, bad news came from exports dropping 22% to the US markets, leading to orders backlog amid stagnant demand. Projected earnings show margins falling 7.5%, and as a labor-intensive industry, tariff risks job losses, and it could hinder Nifty's growth to 26,000 if the exports drag intensify. Now let's tie it all back together. With Q2 showing greater resilience than expected, domestic demand shielded us from the FII outflows and global events. But we are not fully independent yet. We might be closer, but not yet. If the earnings confirm domestic demand outstripped the global challenges, then we can see that 2 to 3% gain materialize, which will mean that the Nifty crosses 26,000 by late October. Risks like weak bank or rising CPI can cap it, so stay vigilant. At Hedgeonomist, we believe knowledge is the ultimate hedge against market shockers, equipping you with insights to navigate uncertainties like tariffs or global shifts, turning potential pitfalls into informed opportunities. So let's hedge smarter together. Drop your thoughts in the comment, and if you like this content, please subscribe. Thank you for tuning in. Bye-bye.